let's talk more about these markets here. I do want to bring in our next guest, Doug Flynn, co-founder of Flynn Zito Capital Management. Doug, it's great to have you with us this morning. So we did find out yesterday that these global coronavirus cases have topped 10 million, yet the market up today. Why is that?
You know, I think you have to digest the fact that a lot of what we're seeing now is sort of going to be a bumpy and regional claw back to normal. And so that's what's happening. It was, in New York, and now it's in these other parts of the country. So you kind of have to digest that. I think that's what the market is trying to understand. And also, after this huge run off of the bottom at the end of March, it is very normal to, looking very positively say, oh, let's take a step back here and digest a little bit this as it spikes here and there.
Do you think stocks are frothy at these levels?
On a historical basis, they definitely are. There's a lot of measures, whether it's the 25-year average PE ratio that a lot of people look at. But I think what you've got to do, and what we've tried to do here, is magnify the normal PE by the amount of the stimulus. And I don't think people really have accounted in fully what the stimulus impact is going to be. So if you do include that into your numbers, you're basically sort of fairly valued. You're not overvalued. I think coming off of where we were on June 8th makes this a little bit of a better pricing for the market. We were getting close. Look, to be positive year to date through this on June 8th was probably too much. So coming back a little bit off of that is not a bad thing. It gives you some opportunities. I don't think we're overvalued if you impact stimulus into the overall earnings ratio and what's going to happen next year with corporate earnings.
Okay, interesting. So if you have money on the sidelines, right, you see these coronavirus cases rising, you see new hotspots, especially in the South and in California as well, right? This is going to impact GDP output, the fact that these restaurants, these bars, these beaches have to actually close. But if you're an investor with money on the sideline, would you advise those investors put money into the market right now or maybe wait for more of a dip?
Yeah, I mean, you could see a little bit more of a dip. Look, we haven't seen the second quarter GDP numbers yet. They're going to be absolutely horrendous. And so we have to digest that. We're not going to get that until the latter part of next month. So, yeah, and fully expecting last quarter's GDP only accounted for like a couple of weeks to a month of the downturn. This upcoming one, this quarter that's ending this week, which we'll get those numbers next month, are going to look bad. So it is likely the market could trade down on those numbers as people first see them, because admittedly, they're going to be the worst GDP numbers we've ever had. So with that, you have to pick your spots. And I think that's where the opportunity is. There are opportunities in the market, as there are in any market. And I don't think you want to chase things. People tend to do that. So if you find your spots, find some companies that you think are great. Look, there's going to be companies that are not going to make it through this, but there are going to be companies that are going to take advantage of it, that were well suited and are going to take market share from those other companies. Those are the ones you want to look for and pick your spots to get in. I do think there'll be some opportunities.
Is that big tech? I mean, it seems as if we've only seen big technology consolidate more power amid this pandemic.
Yeah, that's true. In fact, when you look at those, the top 5 companies in the S&P, they're over 20% of the S&P. I mean, I always say, where is that going to go? Are they going to be 30% of the S&P? At some point, other things are going to take over. And I've been doing this long enough to see those trends move. It happened in the late 90s into early 2000 when tech did take a downturn and other things kicked in. Right now, if you look at the market, probably the most unloved and under invested in area right now, and the absolute cheapest on a relative basis, are mid-sized companies on the value side. Nobody wants those, but if you look at them historically, they're one of the best performing asset classes, but they're so disconnected and so out of favor. That's the opportunity. And so I would definitely look into that. And if you don't have any representation in there, it's a nice offset to the big tech area that is probably overweighted in your portfolio.
Interesting. Okay, so let's talk more about what July is going to bring. You mentioned the second quarter GDP figures. We know that those are going to be really bad, but on top of that, company earnings are going to start to roll in mid-July. How do investors factor that into the market, that it could be weeks of really bad numbers for corporate America?
Yeah, I think, by the time we get those numbers, most of the companies will already have had an uptick back into the positive. So I think what's going to happen is I think you're going to see some of those numbers, but they're probably going to give advanced guidance on what's going to be coming just to kind of soften some of that. But look, it is going to be ugly, and some of these companies were not well suited. They were indebted. They did not, all this did was fast forward the problems that companies had that were not well capitalized. And therein lies the problem. It just sort of sped up the inevitability of these companies that weren't going to make it. And so that kind of flushes it out. But that represents an opportunity. So you really have to do a little bit more digging, I would say, and analysis in picking your companies, especially when you're deploying capital over this second half of the year. That's the way that I would look at it.
Is there a mid-sized value ETF or mutual fund that you'd recommend, Doug?
The greatest things that you can do is absolutely there are mid-cap value ETFs and funds. And what I often will do is take a look at some of the big names that and look at their top 10 holdings and scan across them. There's going to be some names in there that you recognize and probably didn't know that they were mid-sized value companies. And then there'll be some names in there you've never heard of. And so do some analysis there. But that's the way that I would look at it if you're looking for individual names. But absolutely, there are ETFs that are in this space, and you can easily find them. All the major providers have them, and it is a great, inexpensive way to get involved in that area. A lot of people are really underweighted there, so I would really look forward to it. It might be early, but some point over the next year, getting positioned there or rebalancing into that, or maybe not adding more and more and more into tech when it's already so high a percentage of your portfolio. Don't sell that, but maybe put new money to work in these areas that you don't have anything in.
Interesting. Okay, so former FDA Commissioner Scott Gottlieb saying on another network this morning that by the end of the year, at the current rate, roughly half of the population will likely have the coronavirus. How does the market move based on that?
I think, as long as the deaths continue to go down, that's the biggest thing that you want to see. I think, obviously, the more testing and more people that have it, the percentages are going to bring this more in line. And so I think it's really like anything else. If you go back to other pandemics, and that's what I've taken the cue from. There are other pandemics that we can look at to see how things reacted and look at the market. There's going to be a disconnect from what's going on personally, and as sad as all that is on the individual level, and then translating that into the shift towards online and the other areas that are going to capitalize on this. And you sort of have to remove your emotion from that when you're analyzing whether or not you want to invest in companies that are going to do well. Whether it's in the healthcare industry or areas that are going to take advantage of the online shift to shopping and the new way that people are going to do things for a little while. Look, there may be some long-term changes, but eventually people do go back to their normal ways because we all tend to have very short-term memories when it comes to bad events. So as horrible as that is, I think it's all part of the process of getting to the other side. And honestly, I think at the end of next year, we're probably going to be back to all-time high on the corporate earnings side, which means all-time high in the markets once again.
Interesting. All right, Doug Flynn, he's the co-founder of Flynn Zito Capital Management. Doug, thank you.